So today we're going to talk about saving versus investing. And as you guys know, the Fed's increasing rates, so it's more expensive to borrow, but also it's better to save. So the rules have changed a little bit, so stay tuned. So number one, we all need to have savings. But two, we all also need to invest, because if you're just saving, you're falling behind. This is precisely the reason in Rich Dad Poor Dad, where Robert Kiyosaki says savers are losers. They're not actually losers, but they're actually losing against inflation. More on that later. So for savers, typically they're not spending money as far as investing, and they're not very financially educated. I know that's probably going to offend a lot of you, but it's true. Most people that are saving are afraid to invest because they lack the financial education. Most savers work for money. In other words, money is a claim on their time. They're working hard, they're saving money, but it's immediately going out in the form of rent, car payment, or even credit card expenses or things like that. It's typically passive. In other words, it doesn't take a lot of education and they don't have to think about it. So passive means that they just put it into the bank and it stays there until it's gone, and then they're working from paycheck to paycheck. Typically, savers have short-term goals. So if you're a saver, all you need to have is a little bit of a longer-term goal. Typically, savers have short-term goals and they're working paycheck to paycheck. Now, the reason a lot of people are savers is because there's absolutely no risk of losing the money. They know that if they put the money in the bank, one way or another, they're going to get covered by the bank. Even in these past bank failures, even the ones that we had 20 years ago, the FDIC and the government stepped in and made sure that everybody had their savings account. So a lot of times savers perceive risk taking the money from savings and actually investing it into something that might be growing for them. The problem with this, of course, which is the next thing, is that there's no opportunity for that money that they're saving to earn money. And that's precisely the problem. The money that they've got is actually going toward expenses, and that's it. It's not growing at all, and therefore savers are falling further and further behind. Typically, savers are low risk, low reward. They're fear-based, and they have a scarcity mindset. And this, my friends, is all just about financial education and learning. I used to be in this exact same mindset. My parents, many of my family members, and of course, many of my friends fall in the saving category, but what happens is they're falling further, further behind. They have a scarcity mindset. In other words, they believe that they need a lot of savings in order to afford things like vacations or food or whatever. They don't realize that inflation is actually eroding their savings purchasing power. Savers typically pay higher tax because many times when you invest in things like oil and gas or real estate, you actually have tax savings or tax benefits or even tax credits. You often don't have those when you're just saving money in a bank account. And by far the top enemy of savers is inflation. And we're going to go into more detail in that in the last slide. So now let's move to the investing side of the equation. Investors typically have some kind of a plan to invest in something that makes money on their money. They're typically a little more financially educated. I'm not saying that they don't have savings, but there's a percentage or a plan that they have each week or each month or each year toward investing. Their money is typically working for them and it's active. In other words, it's as active as going to work. They're taking an active role in what's being invested, and they're not just turning their money over to a financial planner or a wealth manager. They typically have long-term goals, and that could be a vacation, that could be another job, that could be buying a house, you could buy and invest in real estate, it could be whatever it is, but they typically are very active and they have long-term goals. The one big problem with investing is risk. It's easier to have money in savings because there's almost no risk, and there certainly is risk in investing. And this is where the education piece comes in, because with investing, you're actually looking for tax benefits, you're looking for passive income, and of course, you're looking for a return that's compounded year over year, making yourself more and more money. In other words, you're earning money on your money. So investors look for an opportunity to make money, and oftentimes they feel like having savings is actually risky, when in reality, investing is more riskier than saving. Most investors look at savers as risky because when you're sitting in a savings account with a low interest rate and inflation is higher, they view that as losing purchasing power over a period of time. Whereas if they have excess savings, they're actually trying to invest it, so they're beating inflation and therefore keeping up with it. Of course, with higher risk, oftentimes you have higher potential reward. And that is kind of the whole point. When you're sitting on savings, you're fear-based and you're afraid to make a move, whereas investing is calculated, it's strategic, and you're, of course, trying to stay ahead of everything. Typically, investors have more of an abundance mindset. Of course, they realize that money can make more money, and of course, they're looking for other ways to spread that risk over many different things like oil and gas, gold, real estate, stocks, mutual funds, whatever it might be. But they're typically more diversified. In most cases, investors pay less tax. If the government wants people to invest in oil and gas because they need it, they actually give tax breaks and tax credits. Same thing with real estate, where we get depreciation and cost segregation because the government actually wants people to invest in housing because they need housing, and therefore they give you tax benefits for that. The top enemy, of course, in investing is you, because what I've seen a lot of times is people throw their money around without doing a lot of due diligence. I did this myself with a gold mine in Las Vegas years ago when I was in my 20s, and I fell for it and I lost all my money. And so for me, I realized that I had to do more due diligence on what I was actually investing in. I had to look into the partners, I had to look into the deals, I had to look at the returns, I had to look at how the whole thing was being run, and of course, when I was going to get paid back. So there is a lot more education on the investing side, and trust me, it's going to be how you get ahead in these crazy times that we have coming. So whatever side you're on, whether you're a saver or investing, just know that there's pros and cons to each. But right now, especially with where we've come from with all this high inflation, savers are actually losers, because we all know things are a lot more expensive than they were just a few years ago. So if you had $10,000 in the bank 3 years ago and you still had that $10,000 in the bank today, it buys less of what you used to be able to have to buy. So now let's take a look at the math between savings and investing. So on the left side of the graph, you're going to see the inflation rates. As you can see, going back 10 years from 2013, inflation was pretty good. It was 1.5 up to a little bit over 2, down to about 1.4 in 2020. And we all know what happened from there. It jumped considerably. So take a look at graph 2. So this was the savings rate during that period of time. And as you can see, the savings rate was well below 1%. The banks didn't really care if you had their money in the bank at all, and they were paying minimal interest expenses. Now, the online banks had a little bit higher. So for those of you who are a little bit smarter, maybe you had some online bank interest rates that paid you a little bit more. But you can see from the graph, if you started with $5,000, you can kind of see that the one on the left, the traditional bank, you barely had any interest paid on that $5,000 that's sitting in the bank. At the same time, take a look at the graph to the left. You can see the inflation rates were all over the map, and you can see that you're going backwards financially. So if you had money in your savings account, you can see it was barely worth the $5,000 over that 10-year period. And if you use inflation, you can see that it actually bought quite a bit less. There's one big change that we've all experienced in the last year with the Federal Reserve. That is that they've jacked the interest rates. So what's happened at the same time, the banks have had to jack their savings rates. So right now, it's very common for you to have 3, 4, even 5% savings rates. Using the same graph to the right, if you put $5,000 in the bank at 5%, you're now going to have $5,250. A significant difference in today's marketplace. The other thing on the investment side, you got to realize that you're also getting compound interest. So that $5,250 is actually going to make $262 more in the following year, because you're now getting interest on interest. Therefore, you're now participating in compound interest. This is exactly what the investors have been trying to do prior to these higher savings rates. So now what we're experiencing is if you have a lot of money in savings, you're able to get 4 or 5% interest rates on your savings accounts. And we haven't had this since 1979. So now it doesn't look as good on the investing side, because in order to make more than that, you're actually going to have to be invested and making money at 7, 8, 9, and even 10%, because the savings accounts are generating 4 and 5%. So as you take a look at where to put your hard-earned money, do you put it into savings or you put it into investing? It's largely based on what the savings account is and, of course, what the investing risk is. So if the savings accounts are sitting at 4 and 5% and you're going to invest and you're only going to make 4 or 5%, then by all means, it makes more sense to actually save because there's less risk by saving. But if you're going to take that 4 or 5% of the savings and invest it into an asset that's producing 7, 8, 9, 10, even 12%, then of course it makes more sense to move over to the investing side, and you might get tax benefits for it. The big issue, of course, in this last slide is all about inflation. And of course, inflation has been silently robbing us all from our purchasing power since about 1913. And this is a great illustration where you can see a shopping cart full of groceries with this $100 bill that I've got here in front of me. And that's what it used to buy, of course, about 100 years ago. Fast forward to 2020, you can see that shopping cart is about half full. Soon, this $100 bill will not buy you much because inflation will silently continue to rob your own purchasing power. So the point here is if this money was saved in 1913 and it's still sitting 50 years later, it actually buys less, and that's the point. So as you're watching inflation, like food alone has gone up 30% in the last 3 years, anywhere from 10 to 12% per year since 2021. I can assure you that wage growth has not grown that fast. And so unless you're making more money, you're actually losing purchasing power if your money is sitting in a savings account at less than 1%. And that is the lesson here, guys, is always monitor your hard-earned money and what is it making in a savings account and what is it making on an investing account and what is inflation. Make sure that your hard-earned money is beating inflation, because if you're not, you're silently getting robbed from your own money because inflation is actually moving faster than your money is actually making.